we're going to go over some of the notes for chapter 10. And so I'm going to use some of the slides from the PowerPoint, and you're welcome to go back and use the PowerPoint that's in Canvas that would have all of them in it. I just pulled out some of the ones I wanted to discuss this morning. And so I'm going to just wade through them of these and make some comments. And then we'll do a different video with some exercises. Okay, so first thing is we're talking about sales. And so this chapter is talking about sales, which could be from a manufacturer making a sale to a wholesaler, or it could be from a wholesaler making a sale to a retailer, or it could be a retailer making a sale to the final customer. So normally there's that three-step process. And so the main things we'll be talking about here is where wholesalers sell to the retailers or where retailers sell to the customer. And in the long run, it's mostly about the retailers selling to the customers. But in any case, we're just going to discuss some of these forms first, and then we're going to talk about the new accounts that we added, and we'll process through some of the needed accounting records that we have to deal with, which is just the detail accounts receivable that are tied to these sales usually. So it's just digging a little deeper into something we've already been exploring, which is making a sale and our customers either paying us or putting it on account. And so we're just pushing in a little bit deeper onto the actual sales transactions in this chapter. All right, so the first thing I've got here is a sales ticket. Normally this would be used when a wholesaler sells product to a retailer. That it would be on accounts, usually accounts receivables involved, and a wholesaler sells to a retailer because they have this long relationship generally that they buy from this certain supplier that they're going to need to have the product on hand to sell to their customers. And so the retailer is buying from this wholesaler on credit normally rather than cash. It could be a cash transaction, but usually it's accounts receivable. Okay, and then the other thing is this sales ticket is sort of like the old-fashioned way of recording it, but the reason we study it is that the modern ways of doing it still account for the same things that these manual systems used to, but it's just that we put it in electronic form. But it helps you to understand the electronic form if you know what's involved and what's included on the old system or the manual system that used to be used. And there are still some companies that use the manual system. So you do need to be familiar with this sort of thing. This is just a sales ticket, and you see it's nothing sophisticated about it. It just is a way to keep track of what's happening. And so you see they've got the who the merchandise was sold to and their address, probably. I don't see it on there, but it would have their telephone number and their email address these days. Those kind of things would all be on that statement. And it would show what was sold, what's the quantity, what's the product, how much it was. It would add tax usually, unless there's some reason they were exempt from sales tax, they would add sales tax. And so that sales tax is included there to bring them to a total amount that's going to be due from that retailer back to the wholesaler. And so then of course it's got the date that it happened. And usually it's got a contact person at the company that's selling on the form. Okay, so that is the way it works. But these days, probably 99.9% of all sales that go from wholesalers to retailers are electronically recorded. So they have sales tickets, yes, but it's in the computer system. And so they have computerized records that account for these same things, plus a whole lot more information. And it's so sophisticated these days that it becomes a system many times is actually integrated with the retailer. So if you hear people talk about supply chain, that's what they're talking about. Is like if Walmart is buying from a certain supplier, then they do make their own product also, but they buy a lot of product from other people that they don't make. They just become the retailer. So when Walmart buys from another supplier, probably they don't have to fill out a form like this that we're looking at. And they don't even have to go to the website for the company and place an order. More than likely, their internal system has a connection to their supplier where they can just go into their own system and requisition the goods they need, and it automatically is connecting to the order function of their supplier and ordering that material. So it'll show up even without having to leave the supply chain system that is embedded in the Walmart inventory system. And so it's really interesting how it all is tied together these days. But in any case, this is the basis of it all. No matter how it's being accounted for now, this information still has to be there. And so that's what we need to remember. That's the only reason we're looking at these manual tickets, because more than likely when you go to work, you won't be dealing with these manual tickets. You'll be dealing with a system that is recording the same type of stuff. Okay. So that's when a wholesaler sells to a retailer, usually they would use that. Now, whenever a retailer sells to their customer, they usually have something called a sales invoice. It talks about the same thing, but basically, usually it just shows the same. It says the day. It's usually, if they're going to sell it on credit, it'll have terms. If it shows terms right here, anywhere on the form where it says terms, this phrase, I pushed it back, push it forward. Okay, let me go back. This phrase 210 in 30, we'll talk about that later in the slides, but basically that's just stating what the arrangements are between the seller and the buyer. And so whenever you have a retailer selling to a customer, you almost always have terms. There's either going to say cash or it's going to state the terms. The seller determines the terms and they're going to state what they expect, how soon you have to pay it, if you can have a discount if you pay it early, and what's going to happen if you don't. And so we'll talk about that in a minute. But the customer's name would be listed there, the date, the terms, and then the product. What's the quantity? What's the description? How much a unit price is and how much the total price. And then it's extended over. So you get these totals and you come up with a total you're charging the customer. Now, again, sales tax normally would be included on the sales invoice. They did not include it here, but that's probably because a lot of states don't tax services, and it looks like, no, that's actually paint. So that should be included with sales tax. But anyway, they didn't put in sales tax, but it definitely very good chance it would have the sales tax included on it. Okay, so that's just, it's very similar to the sales invoice. The sales ticket is very, sales invoice and the sales ticket is very close to the same thing. And then when you get to the credit memorandum, that just is saying this person brought some of the merchandise back. This would be tied to sales returns and sales allowances. Sales returns, basically, we're going to talk about those again. These are just the documents right now, but we're going to talk about these new accounts that are added, and sales returns and allowances is one of them. And basically, this is just a form you fill out to track what kind of return or allowance you're going to credit back to that customer's account, because you don't want to have them to have to pay you even if they return some of the goods. So that's just telling you all the same stuff, but this is a reversal of the sale. Okay. So these are just some of the forms we've added because we are getting a little deeper into sales. All right. So these are the new accounts that are being added to our register, because, we've been talking about service industry so far. And so we talked about fees earned, maybe, service fees, a lot of different names, but how I always want them to say the word revenue and they just won't say the word revenue, but they could say service fee revenue. They could say fees earned revenue. They could say sales revenue, but no, they don't want to say the word revenue for some reason. But I always think of it, when I see the word sales, I always think sales revenue. The only way I don't think it's sales revenue is if it has another word after it. So like sales discounts or sales tax payable or sales returns, those I know aren't sales revenue. Those are some kind of usually contra revenue accounts. But in any case, if it says just the word sales, you think of it as sales revenue. Okay. All right. So the accounts we're adding, sales revenue, which is just a normal revenue account, just like we've been working with. And then sales tax payable is a extra tax that we're collecting that is not actually our revenue. We're collecting it for the government. And so sales tax payable, we'll work on these a little bit more deeply as we go through, is something that we have to keep track of. We have to record each time we make a sale. And then sales returns allowance, I mentioned earlier, that's just when the customer's bringing some of the goods back or asking for an adjustment on the price because of problems with the goods. And then customer refunds payable is where we're going to allow a discount and we're just recording it in advance, but we haven't paid it out yet. And then sales discounts is those discounts we're allowing is a contra revenue account that shows the reduction in the sales price. Okay, so we're going to talk about each of these and how to record them. So I'm just going to go. Oh, one thing I meant to mention, I have it in my notes. The other thing about sales ticket, let me go back to that one just 1 second. This sales ticket, sales ticket example. I'm sorry. I think, you, instead of having, I think I just told you guys wrong. Sales ticket is generally what you do for the customer. That's where you're charging the sales tax. So that's where I got them flipped. Sales ticket has all the same information as a sales invoice, but normally this one is the one that's used when you're selling to the customer because that's the one that has the sales tax on it. Sorry. But a lot of times, rather than using a sales ticket, what you'll do is a computerized sales record, or another name for that would be a cash register summary. And so if you are a small business, you might have a cash register that would print out at the end of the day a totals figure, and that would be what you would use to record your sales that day. But if you are a big corporation, or maybe even a small one that's just got a computer system tracking your sales, you would use like a scanner for the UPC codes, and it would record the sale automatically just from scanning it. So it would keep track of your inventory change at the same time it's recording the sale. So then you just look on your computer to see what your sales were that day. So a cash register tape summary, or the computer record where you have sold through a UPC code scan, then those would be the way that the alternative to this physical sales ticket. And then the sales invoice, the reason, this is why I was confused a minute ago, the reason they didn't have sales tax is because that was where the wholesaler was selling to the retailer. So they didn't charge sales tax until they got to the end consumer. Okay. All right. Now, sorry about that flip on those two. Okay. So then we got that credit memorandum. We talked about that. This one usually is related to the retail side of things too, where retailers sell to customers because it's just a return. The customer hand it back and you have to refund the tax part too. Okay. And then we talked about each of these accounts, and we're going to talk individually a little more about each of them. So the sales account we already know about because it's just a regular revenue account. The sales tax payable is the one that's really new. And so this is just a liability account where we're tracking how much we're going to owe to the government that we collected from our customer. And so we're going to record that every time we make a sale, because we're going to debit either cash or accounts receivable. And we're going to, you see, they debited accounts receivable with the customer's name noted there. And that's because that's the most difficult one, more than cash. Of course, if it's just cash, it's easy to account for. And then we credit the sales account for whatever the sales amount was, and we credit the sales tax payable for the extra that we collected that was for, or that we're going to collect, that was for the sales that we owe to the government. So the only time you would ever, a sales tax payable is a liability account. So of course it has a credit balance. And the only time you would debit it is when you are returning merchandise. So if you're reversing the sale, it's the only time you would debit sales tax payable, or if you're paying the balance. So sales tax payable normally takes a credit just like the revenue account, because liabilities and revenue both increase with the credit, right? And at the time you're making that sale, you're increasing the sale, you're increasing the liability to the government, and you're increasing either your cash or your accounts receivable. So when you increase cash or accounts receivable, of course, you're going to debit, because those are asset accounts. So that's just telling you why this journal entry makes sense. Okay, then another account, sales returns and allowances. This is when the customer returns some of the goods that we sold. So if you had an absolute return, it would mean they gave you the merchandise back and you give them the credit on their account for the merchandise, and you just put it back into your inventory. And so that would be an actual return. Whereas an allowance is the case where the client calls you up and they're like, this product is terrible. I can't believe you sold me this. Da, 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 da. They're ranting. And you're saying, oh, I'm sorry. I don't want to lose you as a customer. So let me see, I'll make an adjustment for you. I'll reduce the price this time, and we will be very careful to make sure we don't give you any substandard goods in the future. So that's an allowance whenever you give them just a reduction in the price to try to pacify them. And so it's a contra sales account. So in other words, it increases with a credit because this is just where you're reducing a piece of the sale, some or all of the sale. So when you record that, it's like you are just doing the reverse of a normal sale. So you credit the accounts receivable to reduce it down. They don't owe me that anymore. And you debit the sales account, but you want to keep track of how much you've had to do this for. So rather than just debiting sales, you debit sales returns and allowances to track it better. And you also debit the sales tax payable because you reverse the sales, so you're not going to have to pay that to the government. All right, sales discounts is another one that's a contra revenue account. So again, it's going to be treated the same way. It's going to take a credit normally because unless the discount expires. Let's see if we can see the journal entry. This is what the journal entry looks like. This is they're only recording the sales discount when the actual discount is earned or when the payment is made. So let's go back and talk about the terms of this first before we do that. Okay, so when you make the sale, just recording as a regular sale, debiting accounts receivable or cash, whichever it is. If you sell on credit, it's accounts receivable, and then you credit sales and the sales tax payable, and just the whole thing. The gross method is what this is called, meaning it records the whole sale. Doesn't assume the customer is going to take advantage of a discount. It just assumes here's the sale. If they take advantage of a discount, then we'll record it. So let me talk to you about the discounts. There's these terms I was telling you about that's listed on the sales ticket or on the sales invoice. The terms, either one, if you sold to a client or if you sold or if a wholesaler sold to a retailer, either way, there could be terms that included a discount. So the terms, though, are a little way to phrase it, which just means these are what we're going to do. The seller determines these terms, and there's three things that might happen. So the first thing that might happen on the terms is they might give you a discount if you pay it early. So this is just 4 examples of the way terms could be stated, but it could be any number of ways. But I just want to make sure you understand this is not about fractions. This is about just a way to present the terms. So let's just look at the top one first. 210 net 30. I'll go back. I don't want to go back that many. 210 net 30. I was trying to make it bigger, but it doesn't want to cooperate. So 210 net 30 just is telling you 210 is one possibility of what might happen. 210 means you can get a 2% discount if you pay within 10 days of this invoice. So that's part of the terms. Here's an offer for you. You pay early, I'll give you 2% off of the price. And so 210 net 30 means if you pay within 10 days, I'll give you a 2% discount. So that 2 is always talking about what percentage off I'll give you if you pay within this number of days, this 10. So looking down at these other options, 110 net 30 means I'll give you 1% off if you pay within 10 days. Okay, now the third one. This one, the first set of terms says 2 slash EOM. EOM means end of month. So I'll give you 2% off if you'll pay before the end of the month. And the comma is just separating to say that was my early payment offer. That's what I'm offering. Now the last one was 310 end of month. So that's saying I'll give you 3% discount if you pay by the end of the month. So all these first ones that are before the first comma is the first option. And normally it's talking about here's an early payment discount I'm offering you. This is what the seller is telling the buyer. The seller always determines the terms, and the seller is the one making the offer. The second term is how can you stay in good grace with the company. So if you don't take the early pay, what can you do that still makes you a good customer where they want to keep doing business with you? Okay, so here's the terms that they state that makes them happy. So this first one said, I'll give you 2% off if you pay within 10 days. The second term for that term set is net 30, which means and you're in good shape as long as you pay the net you owe me within 30 days. So 210 net 30 means pay early within 10 days and I'll give you 2%, or at least pay by the 30 days from the day of the invoice, the amount you owe. And there's this unspoken nastygram that does not show up in the terms. And it means these are the only ways you can stay on the good side of me. This is a seller talking. These are the only way I'm going to be happy. So the third unstated nastygram is if you don't pay early, And if you don't pay within 30 days, then the third option is I might turn you over to collections, or I might stop doing business with you. Or third, I might convert this accounts payable or accounts receivable I have that you owe for into a note and make it a note receivable, which includes interest. So the three nastygrams are, I might not want to do business with you, I might want to add interest to this account, or I might turn you over to collections. So that unspoken thing is a pretty powerful way to get you to abide by these rules that they set, the terms, at least by the second set, which is how the minimum way to make the company happy, the seller happy. So in the second case, 110 net 30 means we're all good. If you pay within 10 days, I'll even give you 1% off. If you pay within 30 days, we're still good. If you don't, we're not good. And we might not keep rocking like this, probably won't. What we'll probably do is I might have to find somebody else to sell to, or I might have to add interest, or I might turn you over to collections. And then on the third set of terms, it says 2 EOM net 60, which means I'll give you a 2% discount if you pay by the end of the month, but at least pay the net you owe me within 60 days. And then the last set says 310 EOM net 60, which means 3% off if you pay within 10 days or the end of the month. That's weird. Okay, well, I'm going to read it. Within 10 days after the end of the month. Let's read over here, Janice is telling you. 310 EOM means 3% off if you pay within 10 days of the end of the month, or at least pay within 60 days of the invoice date. Okay, and so all of these are just ways the seller has determined that we can be happy if things work like this. And so that's important to know. All right, so we don't record that under the gross method until the payment's made. And then we look at the day the payment's made to see if they're within their discount period. And if they are, we're going to give them credit for it and credit their account. So what happens is if the merchandise is sold, this is an example we're going to use. If the merchandise is sold for $100 with credit terms 210 net 30 and cash is received within the discount period, so within 10 days, 2 entries are made. First one was made on the date of the sale. Just like always, we're always going to make that entry. Debit the receivable. If there's terms stated, you know it's a credit sale. So we're always going to use accounts receivable if there's terms involved. So debit accounts receivable, credit sales. And if it was a retailer selling to a customer, we would also have that credit to sales tax payable. But this must have been a wholesaler to a retailer because they didn't charge the sales tax. Okay, and so then on the day of the payment, what happened is less than 10 days later, or 10 days or less later, we're going to give them 2% discount, which is going to be $100 times 2%, $2. And so what we're going to do is we're going to credit that customer's accounts receivable for the full amount they owed us, $100, because we need to clear that whole accounts receivable out. And we're going to debit cash for the 98 because they didn't have to pay that $2. And then we're going to debit sales discounts for that too, because they were able to pay us just 98 if they paid within $10 days. So that's how you would record it. Okay. Now, we're going to practice some of those in an exercise, so don't worry, that'll be in a different video. There's accounts receivable ledger. And so we'll record everything just like I showed you with a debit to accounts receivable, but we also have to keep track of which customers owe us. So we have what's called a subsidiary ledger, and it is to record each individual client or customer's list of what they still owe us. So it's an accounts receivable ledger. And so we're going to play with some of these too, but this is a very important concept. This is a double posting basically, because we're trying to get the detail, in the subsidiary ledger, but we're going to put only the total in the accounts receivable account, which is considered the controlling account. Okay. And then the next thing that's important to realize that's different about this is the bank credit card sales. We're going to see how to record those, but you treat them basically as if they're cash sales. So you just have to record that extra fee that the credit card company charges you. But basically, it's just like a cash sale because the customer doesn't owe you anymore once they give you the credit card. So it's considered paid from that perspective. So we wouldn't record it to the customer's accounts receivable. We would record it as if they had just paid cash, but we just have to include that other fee that the credit card company is going to charge us. So let's see what we do. So we got a sale of $100 with this $5 sales tax, credit card fee of 4%. And so that would be, we would record 4%. The credit card gets their percentage even of the tax amount. So whatever the total is that's owed, the credit card company gets their little clip. That's a percentage. They don't just get 4% of $100. They get a 4% of whatever the fee is that we're charging through them. They're not worried about how much we owe the government or any of that. They just want to know the total they're supposed to front for their customer to pay us. And so 105 is what they're paying, the credit card company's paying. And so they are going to charge their fee on the whole thing. So what we do is the part of the entry that we know best. So when we look at it, we see there's a sale for $100 plus sales tax of $5. We already know what to do with the credit side. We know to credit sales for $100 because that's how much the sale was. And we know to credit sales tax payable for $5 because that's what we're going to owe to the government. So 105 is on the credit side. Now we need $105 worth of debits also. So basically what we're going to do is record the fee. We're going to record cash. Yes. So put the word cash and put the word bank credit card fee or credit card expense or whatever you want to call it, but it's going to be some way we're going to track the credit card cost. And so we have these two account names. We know it right. We just got to figure out how much is we're actually going to get in cash and how much the credit card company is going to get. So the easiest way to do it, in my opinion, is to take the total credit amount because that's the amount we're asking the credit card company to pay for their client. And so we want $105 to be them to take care of. And so they're going to take their little clip out of it. So we're going to multiply 105 times 4% and get $4.20. That's what we're going to put as the 420. 420 is what we're going to put, well, fine, as the credit card expense. And the rest of the 105 is all that we're going to get. So the cash we get is $100.80, which is just $105 minus 420. And so we don't actually get the full amount when we take credit cards. So you think of that when you go to the store and you, instead of giving cash to the store, you give them a card. That's because that to us, that feels like we're just paying the same amount as if it were cash. But to the store, they are not getting the full amount because they have to pay some fee to the credit card company. It could be more than 4%. At one time, American Express was charging 5%, but sometimes I've seen Visa and MasterCard charge as little as 2%. And so it could be even lower than that. So it just depends on what the agreement is between the credit card company and the seller. And so that's the seller has to make a contract to accept a certain card. And so a lot of times you'll see companies don't accept certain cards, but they do accept others. And that's because they don't have an agreement that they will accept, say, American Express. For a long time, American Express fees were much higher than the other companies. And so when that happens, some companies don't want to use American Express. So that's why you'll go to some places where they wouldn't accept your American Express card. It's because they didn't want to pay the hefty fee that American Express was going to make them agree to in order to accept their cards. So that's what that's about. Okay, now one last thing in here. I think this was our last slide that I'm going to pull up. Once we do this accounts receivable ledger, those accounts receivable accounts for the specific clients would have their own little ledger, and we would do something similar to a trial balance at the end of the month to record what is the ending balance of each of the accounts receivable that our clients owe us. And so we would just pull the ending balance of each client's account or customer's account and pull a total of all of them, and it should agree with the total that's in the controlling account that's called accounts receivable that's in our general ledger. So we'll play with some of these in our exercises that we do. But that's all for the notes this time.